I want to talk about the differences between a regular brokerage account and a performance report. If you have an investment account, you receive brokerage statements. But if you have a financial advisor, you probably receive a performance report. And I think it's important to appreciate the differences between the two. First, I want to go over some of the basic differences between the two. The brokerage statement is typically dollar-based, showing change in activity in dollars. It will show how much of each type of asset you have: cash, equities, mutual funds, ETFs, and bonds typically. And show any changes, dividends received, beginning and ending balance, that sort of thing. So the key benefit is really accounting for activity. On the other hand, a performance report is going to be percentage based. It will show change as an internal rate of return. So if you've got $10 in a position and a stock and it goes up 10%, it'll be up $1. And that would show on your brokerage statement as a $1 change. But if it was a $100,000 position and it was up 10%, it would be up $10,000. It's the same performance. 10,000 is certainly a lot better than $1, but it's not the investment's fault that you didn't put enough money into something that returned 10%. So when you look at whether something's better or worse than something else, it's better to focus on the internal rate of return on that investment to show how good it is regardless of how much money you put into the investment. That's more a reflection on the investor than the investment. The asset class, this is distinct from the asset types. When you develop a portfolio, you don't decide to put 20% of your money in equities and 30% in mutual funds and 40% in ETFs. You decide how much you want domestic, international, large cap, mid cap, small cap, growth versus value, those sorts of parameters. This also allows us to compare how an investment is performing relative to a benchmark. So the key benefit is the performance of the portfolio as well as each component in the portfolio, which allows you to determine what's contributing and what's not. That's what I call attribution analysis. Now I'll show you a quick look at a brokerage account as well as a performance report. This is a typical brokerage statement. Shows beginning balances and ending balances, or performance year to date and for this period in dollars. Shows the breakout by asset type. Then it will go over the holdings of the portfolio. I've blacked this out for security regulators, so you can't see what each is, but it shows the quantity, market price, market value, estimated income. Very basic stuff that's useful to keep track of, but nothing performance related. So income and expense summary, activity. Now this is an example of a performance report. This shows for 3 accounts for a client. I call it the hypo household. We've got 2 IRAs and a joint account. Now we get over here, this shows the top 10 holdings, little performance chart. Income for the last 3, or performance for the last 3 months, income and return percent, year to date, 12 months, 3 years and since inception, by account. This shows the asset allocation, percentages, returns by asset class, domestic and international. On the next page, we have portfolio holdings and unrealized gains and losses. This shows performance quarter to date and year to date by position and asset class. Then we get into the account level performance reporting. And here we get into the meat of the performance. We can see for the entire account how much is in each position, the allocation, the performance of each position and sector for the last 3 months, year to date, 12 months, 3 years, 5 years, and since inception. We haven't had these positions on this sample account that I used as a mock-up. These haven't been here 5 years. But you get the idea. When you look into, say, the large growth category, we can see how the sector's done relative to the benchmark, say the S&P 500, up 4.3% or 13.1%, or any other time period. Come back up here to where we just were, and you can see, oops, here, how each position as well as the whole category has done relative to the benchmark. So you can see the sector has outperformed, and you can go back and look at that at your leisure. But these are actual companies. I've just changed the names for the securities regulators. And you can see which positions are actually contributing and which are detracting over various time periods to help me really understand what's going on inside the portfolio. So I hope that helps illustrate some of the differences between a brokerage statement and a performance report. A brokerage statement is essential. It'll show you if something's not being done the way it should, if you were entitled to something, or if somebody. This is what gives you a report of what's going on in the account. And that's very important to keep an eye on. You should save them, at least your year-end statements. If you ever have a security that's involved in a class action suit, you'll need to provide that as part of your documentation. On the other hand, the performance report is a much more robust management tool to help understand what's working and what's not in a portfolio. Then you can go do some other that's my job, really, I guess, to go do the research to figure out if something's not contributing or pulling its weight in the portfolio, why not? Do we need to get rid of it? Is a manager not doing their job? Did I do a bad job in security selection? Sometimes we need to admit our mistakes and move on. And that's really the key tool to do it. Hope that helps. Let me know if you have any questions.